Welcome everybody. My name is Tu Ostergaard. I'm with H.E. Andersen Capital, and I'm today's host. And with me today, I have Michael Skov, who is the CEO of Hafnia. Welcome, Michael.
Thank you.
And we have 20 minutes together. But before we get started, it's regarding the investor presentation of the Q4 and financial year of 2020. And we'll be spending approximately 5 minutes on 2020. And then we'll look beyond 2020 and into 21 and 22, and then of course into the ESG theme, which is growing also within the tanker business. So I hope that's cool. Just before we get started, your value today is approximately 6.2 billion Norwegian kroner, and your stock is up 6% year to date, and 12% the last year. So that's at least a start, Mike.
True.
I'll be controlling the slides, but why don't we dig straight into 2020, and maybe you can give us a sort of introduction to the numbers. I think let's start here actually, with the earnings and stuff, and I'll have a few questions.
Yeah, so I mean, first and foremost, let me just say that 2020 was obviously one of these years where, we were right for the wrong reason, so to speak. And I think, despite the fact that the financial result was very, very strong, and I'll get into that in a minute, what we're going to remember the most from 2020 was, of course, all the difficulties that, the world had and also we had in terms of organization, employees, as we have seen, right? So I think it's not a year that we look back on with a high level of satisfaction from a human point of view, but what did happen is that for various other effects, it has ended up being one of the best years, actually the best year in Hafnia's history so far, and one of the best in the history of product tankers for really many years. So that was the positive part of it. As you can see here from the slide you put up on the top left, so we end the full year of 2020 with a net profit of $148.8 million. You look further on to the right side, we put a little bit of a benchmark up in terms of the financial targets, and we did 13.1% return on equity. We've done a little bit of comparison numbers, but I think these numbers are the key numbers for last year from us, including on the bottom right, and I think you'll get into that in a minute. As you can see on external fees, we made $23 million, all based on fees earned from us managing other owners' vessels and supplying various third-party functions, including bunker purchase, etc. But I think we'll talk about that in a minute.
Yes, definitely. Michael, why don't I ask about that already? Because it's such a substantial part of your earnings actually now. So can you continue to grow that part?
We believe we can, and it's definitely part of our strategy going forward. There's no doubt that when you look at the core business of Hafnia, which is of course to own and run ships that are transporting oil, we have also at the same time wanted to have an asset-light path, which basically means that we're using the knowledge that we're building up on owning vessels and operating vessels and try to make more money out of that by using those expertise in, for instance, pools, consolidate, purchase of bunker fuels, etc. But there are also other areas that we haven't explored yet. So what you're going to see going forward with Hafnia is that the revenue stream from asset-light business will continue to grow and will be a prime focus area as far as the strategic goals are concerned.
So in principle, you can double this with the existing organization, or do you need to build a scale, or how do you see that?
No, I don't think we can double it with the existing organization. So I do believe that as going forward, you will have to add resources into it. But I think what's important about this particular area is that it will allow us to adapt to a future that it will involve other ways of transportation than just product tankers and refined oil. So for argument's sake, we can build pools around renewable fuels. We can look at all kind of different aspects going forward, and we can actually learn and explore without having to spend multiple money on investing in heavy assets before we understand which way it's going.
Okay, cool. Because I think that's pretty difficult to understand how you can make so much money on that, but it's really well done. Let me just skip to the next ones. I mean, there's a few things I just want to let you talk about. That you're not paying any dividends this year. Can you just give us a bit of background for that, just to finish off 2020?
Yeah, so well, I mean, we have paid dividend. We
Oh,
just
sorry.
paid it out
The
quarterly,
next,
right? So,
yeah,
so basically, what we have said as a dividend policy is that we intend to pay out 50% of the net profit on an annual basis, but we pay it out on a quarterly basis. So what happened was last year that we had a super strong first half, and as we came into the end of third quarter and fourth quarter, we realized that the markets have worsened so much that we kind of waited until now, basically, to decide whether there was more money to be paid out in dividend compared to what we did in the initial 2 quarters. So
yeah.
we're actually ending up paying more than 50%, 52% of last year's net profit was actually paid out in dividend to the shareholders.
Yeah, excuse me for that. It was just the last quarter, sorry.
Exactly.
Fair enough. Is there anything I think, just seen from the outside, it looks like you had a very good year. Of course, the sort of transition over the year was a bit, it was very, very strong in Q1, and then it ended up in a different situation. Is there anything we should, as investors, be aware of in that context?
Well, I mean, I think actually for us and for me personally, I think one of the key issues and one of the key takeaways from last year was not so much how much money we made over the year, or for that matter, in the second quarter that were very, very strong. I'm actually equally focused on that in the bad quarters, in the really bad quarters where the markets were really, really bad, we actually didn't give away a lot. And I think this just underlines what Hafnia was always about, is to make sure that we have a low cost structure. And so even in bad markets, it will never be a disaster. And I think last year is a good example of us almost keeping, not all of it, but most of the money we made in the beginning of the year, even though the market was significantly worse in the back end
Yeah.
of 2020.
Yeah. Okay, cool. If anybody has any questions to 2020, I'll continue on to the future. So if you have any questions, let me know in the chat. I'll skip to this one because I find that very interesting, Michael. That's your sort of comparison with your peers.
Yeah.
And it clearly, of course, it's your slide, so it's sort of, but it demonstrates that on both on return on equity, funding cost, and also your OPEX and SG&A, you're clearly higher on the return side and lower on the OPEX side. Can you give us a bit of hint on why?
Yeah, and I think first of all, yes, it is our slide, but just to be clear, the peers that we are comparing ourselves to are public companies, right? So basically, this is information that is out there. So it's not us trying to invent what others are doing. Well, I think one of the key issues here is to that. So Hafnia is still a very young company, and I think for sure there is an advantage that you build something from scratch, basically, and therefore you are a lot more cost conscious, and you're building on carefully, rather than coming from, as many of our peers maybe have been around for 100 years, and therefore when things change, they have to kind of to scroll back, if you like, and reduce and cut, and that can sometimes be a little bit more difficult. So I think we've probably benefited from coming from zero and just adding on slowly. But there is no doubt that the one of the key elements for us when you look at the cost side is the funding cost. And I think you're going to see also as an investor going forward that the spread between what different owners are paying for the cost of capital, particularly for the debt side, is going to widen, in our view, already has done, and will widen even more. So it's not like the good old days where basically if you wanted to buy a ship and you had a great idea, you go to the bank and you get 60% financed just because you have an asset as security. It doesn't work that way anymore. So it's becoming more and more difficult to raise debt to run a ship owning company, and so therefore we are in I would say in a unique position, having as low cost of debt as we have.
Yeah, well, that's cool. That's really interesting. Especially on the return on equity side, I think it's striking. Okay, let's skip to the next part, which is basically the forward part, looking part, because I've seen these slides many times, but it strikes me all the time how low they are now, the order books, and so it must be a question of timing before the rates skyrocketing, or am I wrong? How should we look at this as investors?
But I think, I mean, yes, you should look at it that way. That as you can see also a little bit on on some of the previous slides that we have sent out. our industry hasn't really had a big problem on the demand side. If you ignore last year and what happened in terms of COVID-19, oil demand has been going up over many, many years. When you speak to EIA and the big research companies around the world, most of them expect peak oil not to happen in the next 8 to 9 years. So in other words, we're still in a growing demand side for oil. Despite all the good renewable tendencies that is going on in the world, it'll take time. So I think what's critical now is that it's very difficult to order a new ship looking into a future where you don't know what the future fuel for your vessel will be. That's what's keeping the order book low. The reason nobody is ordering any ships is that there is nothing available today which you can buy and then employ afterwards using a renewable fuel as fuel for your engine. So what that means is basically that if you want to buy a vessel that's going to last for 25 years and is able to use a renewable fuel in the future, you will be paying 25% above the current price for a normal product tanker, but you're not going to get any benefit because there is nothing for you to use out there. So this has stopped basically all the ordering of ships. So there is no doubt that the supply side is the lowest we've seen for 20 years. So the real key for the future market right now is really how quickly the world will come back after COVID-19 on the demand side. That's the key element. And as far as we can see, having looked at the market last year, if you'd asked me this question in third quarter last year, I probably have been a bit more pessimistic because we were going into unknown territory. But when we look at where the oil inventories are today, how quickly the world has gone back to consume oil as we slowly open up, there is no doubt that we have brought down the inventories almost to where they were before COVID-19. So on the back end of this year, second half, in our view, if all going well, you have vaccinations rolled out, then we believe that the oil consumption will be back almost on level before 2020 or COVID-19 started.
So that's the demand side. And just to be clear, Michael, on the supply side, you cannot actually order a ship today and get it delivered with any meaningful time length. Is that a correct way of looking at it?
Yeah, because basically all the shipyards have been filling up their space with different types of vessels. So what you've seen over the last year and a half is that big container ships, big crude carriers, big gas ships, etc., military stuff has been basically taking all the space on yards. So even if we wanted to today, you're now talking into 2023 before you can really get any meaningful new ships delivered.
So when for those of you who view this on the left-hand side in the left bottom corner, this supply and demand growth for product tankers, I mean, it is actually zero. Is that correct for 2022?
Correct.
Yeah.
What you're basically seeing is that this year we expect there will be a 2% increase in supply, i.e. new ships coming in, being delivered net, and we're probably seeing an estimate 6 to 7% increase in ton mile for transportation of refined products. But more importantly, for 2022, we expect that the net inflow supply of new ships will be around zero. So that is, you take whatever comes in of new ships, and then you deduct what is being scrapped of ships that are being too old to trade.
Yeah, and then some of the, if you are negative on this industry as a whole, of course you will take all the things for the jet fuel and stuff like that, and you'll be wondering what happens on that market with the COVID-19. Can you comment on that? Can you give us any insight in how you see that?
No, but I think that is of course, jet fuel is definitely one of these fuels that have been hurt demand-wise during COVID-19. What we have seen, of course, is that there are quite a lot planes that's in the air. It's just transporting different stuff. It's not people, it's cargo, and it's shorter distances. But to give an example, jet fuel is probably around altogether 7% of the market for product tankers, what we are sailing with. And so it's not the biggest commodity that we have, and our view is still that what we've seen on the cargo side that has taken up space, as I mentioned, instead of people being transported around. Our view is that you're not going to have any issues with the demand side as long as you have reached a proper vaccination rollout in the second half of this year.
Michael, there's a question here from in relation to if product tanker owners are venturing into new and related shipping and logistic markets to grow and to use the platform as it is. Do you have a comment on that?
You mean for product tankers
Yeah,
in
I think
general?
that the question is if you can be using these ships in other means of transportation, in chemical markets or infrastructure investments or stuff like that.
Yeah, I mean, I think for sure there is a bit of a crossover, if you like, between liquid transportation, whether it's been chemicals or crude or products, that will always be there. But quite frankly, I don't think for a product tanker, looking into what you can sail with today, it's not like there's a lot of other commodities other than what we know today.
No.
But I think our view is, as I said earlier, and I think maybe in this whole renewable discussion, this has been lost a little bit. There will be a lot of oil to be transported and sailed for many, many years yet. Also, that will be beyond the lifetime of the fleet that we have today.
And then, if I might add, you have built Hafnia on consolidation. So maybe that's also a good question. Do you think this will prompt consolidation more? I know you're very eager to participate if it is so. How do you see that in relation to the market? You see it now?
Well, I think, I mean, consolidation for us is really a twofold thing. So on one side, we continue to increase the pool business that we have, which basically means that we operate other people's vessels and gain market share. And then we have the M&A side, putting companies together. And I think for us, this is one of our prime strategic objectives. We still believe that there is room for consolidation, not because of growth and scale in itself only, but because we can see that for the reasons I mentioned earlier, cost of funding, cost of capital, it's widening a lot. When we look at smaller platforms with 20, 25 vessels, our assumptions is that we can probably harvest something like $20 to $25 million on an annual basis in synergies just by combining the smaller platforms into Hafnia. So we believe there's a lot of shareholder value. So we will continue to look for that. And we think that as environmental regulations put people under pressure, as access to debt, finance in general becomes difficult, more expensive, as investments into data analysis to understand how you can improve on operational efficiencies to live up to increased environmental regulations, all of that requires scale and investments. And I think this will be a catalyst for more consolidation in our industry for sure.
Very well. I'll jump to ESG, Michael, because I know that's quite a theme for you, and you take pride in what you do in Hafnia right now. So maybe you could just give a few words on your strategy and IMO 30 and those kind of things.
Yes. So on this slide, at least we've shown a little bit on the pillars that we have established around Hafnia's ESG strategy. So you can see them top left in terms of what the focus areas are. I would like to say that I think as any responsible company that is also listed, when we talk about things like governance, etc., I would always assume that most companies would have done their homework properly and have that because it's very transparent. So for Hafnia, I think the governance side, is certainly as good as it can be in that sense. I think on the environmental side, it's one of these areas where there's constant movement, and as you mentioned, for us the key element at the moment is the international regulation via the IMO around emissions, particular CO2, up to 2030. So this is the initial target that has been set. And in Hafnia, we are at the moment ahead of that, and we expect to be, if you like, to complete the goal of getting to the 2030 goals as outlined by IMO to reach those targets already in 2028. So there's nothing on the environmental side that worries us, and I think it's really a matter of being, I think, a little bit ahead and start planning for how you want the company to look like as you move forward and you continuously improve on your emissions while you run your business.
You actually, in this context, from investors' perspective, how do you see that? I mean, obviously, it's something that you take very seriously, but how's the feedback from investors on your efforts here?
Well, I think, at least from the investors we speak to, I think people are pleased that the industry is finally moving. And I think also, quite frankly, I think that the data, the information we give out is better now than it was a year ago. I don't think it's an easy area to get your head around, right? I think there's a lot of goals and different numbers. We've tried also in this presentation to simplify it a bit. And you know, my view is this, and I think it's an important part for investors to understand as well. We don't believe that there's going to be any regulation out there that will prevent responsible companies from running their business. That has never been the intention, and I've seen a lot of regulations come and go over the years. I think what really matters is if you are a responsible business and you are listed and you are transparent in how you report, you know, you're not going to have a problem with this. You're going to be able to adapt, and you will slowly but surely move in accordance with how the regulation moves. So there is nothing in these regulations that we have seen that in any form and shape scares us or has any form of risk to Hafnia and the business going forward. None whatsoever.
And you will continue to report on a quarterly basis on these issues so that we can follow it as investors?
Absolutely. It'll be totally transparent.
Okay, cool. So final remarks, Michael, going into 2021, what is to expect for us as investors from Hafnia? Is there anything we should be looking out for? Things you can share with us? Of course, the market will be looking at. Is there anything we can look forward to?
Well, I mean, as I mentioned, I think, you know, the company, you know, is in a very good place in terms of the structure and where we are financially. I think we have a good balance sheet. So, you know, it's really about getting past where we are now, which is the final bit of rebalancing inventories from a market perspective. So I think this is the key thing. And you know, once that happens, there is no doubt that we will be very well positioned to take advantage of it. And, you know, I think despite all the concerns that's been about oil and transportation over the last years, we actually had a good year in 2019. We had an even better year in 2020. And I think it's just proven that even in markets that are a bit up and down, you know, we've still been able to pay out very good dividend deals to our investors. And that's also the strategy going forward.
Perfect. Thank you very much, Michael. I'll speak to you soon. And thank you very much all for listening. You can now see this. If you didn't catch it, you will be able to download it on YouTube, on the platforms of H. Andersen and also on Hafnia. Thank you very much. Thank you, Michael.
Thank you very much. Thank you.